Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Lori Graymont. Lori's company is called Summit Assets Group, and Lori has been involved in investing in real estate properties, rehabilitating properties. Started with her parents when she was a teenager.
That's true.
She's very handy with a hammer. And anyway, so she has this company that she's had for a number of years now. I've been a guest several times on the show, so thank you for that, Lori. And also, she coaches people who want to learn to invest in real estate. She has some kits, or you can do it personally. And then also helps people in locating investment properties in different locations, which we're going to talk about today. So, Lori, welcome.
Thank you, Michael. Thank you.
Thanks for joining me again.
Yes.
So, last year when we met, you were principally involved in helping people that were looking at properties in the Atlanta area. And so why don't we start sort of in general about, why would people, for example, in the Bay Area here, think about investing in properties in other places?
Well, the first thing is for them to understand what their investing plan is. So if they're looking to get cash flow or to create investments that build wealth, but maybe they don't have the $600,000 it takes to buy in the Bay Area, it makes sense to look outside of the Bay Area, outside of California, into other states. So invest where it makes sense, live where you want kind of theory. And so that's one of the things we do at Summit is we analyze some of the major metropolitan areas to see if it's time to make investments there for the long-term hold. So we're really into the buy and hold or buy and rent model, and we help our people do that.
Yeah, so this isn't a quick flip type of scenario that we're talking about.
No, this is not a get-rich-quick scheme. This is not buy and flip. This is a 3 to 5 year hold. And I know when we talk to Californians and we say long time, they think 12 months.
Yeah.
No, we're talking 3 to 5 year, hold it and watch it appreciate, because we're buying below the rebuild cost. So we know it's got to go up to at least what it costs to build. And so they'll get that appreciation plus what the market appreciates. And so it's a good time to get in. The benefit is that the rents cover the cost of the property plus give you cash flow, and that's the whole idea, is to build the cash flow along with the wealth.
Okay, so we're going to get into some of those details in a few minutes. But again, so a lot of us have a hard time getting our heads around the idea that properties can be so much less, as far as what you have to invest in other places. In Silicon Valley here, it seems like you can get a nice starter home for $600,000-$700,000, and if you want to get something nice, you're talking $1 million plus. So what's it like in some of the places that you're looking at?
So in most of the markets that we're investing in, you can get a nice 3-bedroom, 2-bath home, maybe 12 to 1,400 square feet, and yes, it has a roof on it. Everything works. The pricing is going to be anywhere from $80,000 to $100,000. And there are lenders that will loan on those, but most people pay cash for that price just because they don't want to use one of their loans for it.
And I think I'll save some of that other stuff until later, some of the other questions in the back of my mind. Well, what are some of the markets really that you're looking at right now?
Okay, so we have opened 2 markets right now. We have a 3rd market that's coming online at the beginning of the year. But what we do is we analyze markets that have had significant falls in prices but are showing a recovery. So we want to get on the trend of it going up already. We don't want to get in a trend that's going down. We look at the market to make sure they have population inflow, so that there's people that live there, and that they have job creation, so the people that live there can actually pay the rent. And there's 2 markets that we've identified right now that are in that affordability price range, and the markets are Atlanta, Georgia, and Birmingham, Alabama. They're about 2 hours from each other. We have investors that are in both markets. They can fly into Atlanta, look at their properties, drive over, see the ones in Birmingham, and leave from there. But they're both, friendly to landlords, which is a key piece. And both markets are very similar in pricing. You know, you can get a house for about $100,000. The main difference is that Atlanta is going to see a little more appreciation because it's a bigger market. They have a population of 5.5 million people. And Birmingham sees more in cash flow. Their population's a little smaller. They're 1.1 million, which is still bigger than San Jose. But you can get rent of about $1,100 on a $100,000 house in Birmingham.
Okay, so
that's pretty good.
Let's add that up. So $1,100 a month?
Yes.
Okay, so $1,100 a month, and that's times 12.
Don't make me do math. I don't have a calculator.
It's about $13,000 a year on a $100,000 house. So,
yes.
So, you know, even before your expenses then, you've got well over a 10% return.
Yeah, so after expenses and stuff, most of these in the Birmingham market will give you a 12% cash-on-cash return if you were to buy it all cash.
Wow.
In the Atlanta market, we're down between 7 and 8% cash-on-cash, but again, that doesn't account any appreciation, which you're going to see a little faster in the Atlanta market because it fell more than the Birmingham market. Okay. So there's more for recovery.
Okay. So, wow. You know, so what can you get on your money at the bank these days? A tenth of 1% or something interest? I mean,
exactly.
So, you know, so it is an interesting thing to think about. Again, we'll talk about some of the other considerations in a moment. But now, why do you think it's a good idea maybe to concentrate a little bit in just a few places?
Well, obviously, the idea of managing properties all over the place is very difficult. And, you know, in the previous shows, we've seen where I've had properties in many different states and cities, and the management's difficult. The tax returns would make you happy. You'd have a lot of tax returns to repair. But the reality is it's just easier. So we focus on a market that has got room to come up, that is good. The Atlanta market is what we call a maturing market, meaning the prices and the rents are normalizing, so there's still opportunity in the Birmingham and Atlanta, depending on what you're looking for. But I wouldn't go buy homes in like 15 different cities, because then you've got a lot of management to look at.
Right. Yeah, we've talked to people, you and I mean, they've got hundreds of properties all over the country, and you just wonder how they do it. I mean, it would drive me nuts.
Oh, yes.
So, I guess I will bring this because you brought up the tax issue. I mean, any place that you've got a property, if it's got an income tax, now not all states do.
No.
But if it has an income tax, then you have to file an income tax return in that state.
You do.
You know, even if you're not making any money.
That's true. And in Alabama, let's say you set it up and you put it in an LLC, which a lot of our owners own their properties in an LLC. Well, you need to pay that state. You need to register your LLC there.
Yeah.
And in Alabama, you need to pay a business privilege tax of $250 a year to do business there, to have your LLC. So you do have to pay attention to that. Now, obviously, the cash flow outweighs that, but those are things that you have to take into consideration as you go into other marketplaces. And that's where we can help, because we do have that business experience.
Right. Now, the other thing is I take it, in fact, I won't just say I take it, I know that you have people in these marketplaces that can actually help you in managing these properties and in maintaining them.
Of course.
Maybe you can talk a little bit about that.
Of course. Yeah, so, you know, obviously I live here in California, and so I'm near the buyers. A lot of our buyers are from California. We actually have buyers internationally too. But what we do is we work with people who are on the ground, local people. We line up property management, we've got handymen, we've got insurance agents, everybody that's on the ground that's necessary to support. I mean, we even have the bug guy, the termite guy, necessary to support the ownership and management of this property. Because buying it's only one step. The whole idea is it has to be managed well and cash flow for the 3 to 5 years so that it's still a good asset to sell down the road.
Right.
And so we help with all that. We have vetted the people, we've worked with them, and then we put you in touch with them so that you can have your relationship. And if things don't go well, we're the one-stop shop. You call us and we'll call them.
Okay. So you can do this yourself, folks, and create a lot of additional work and headaches. Or you can work with a company like Lori's. Obviously, there's going to be some fees involved and so forth for this assistance, but it can make your life a lot easier And if you think about it, I mean, this is kind of an exciting opportunity. So I'm kind of glad to have a chance to have Lori here to tell us a little bit about what's going on and what's available for you. Lori, have you ever had anybody invest in some of these properties using like an IRA or a Roth account?
That's a great question. Absolutely. So what we do is we have people who have IRAs or, the rollovers from 401ks, jobs they've left, and they can use that money to buy these homes, and then the rent goes back into the IRA and it builds the retirement. Plus the home is appreciating, along the way. And so it's a great use of retirement funds because it goes in tax deferred or tax free depending the type of IRA they're using. And let's say 3 to 5 years down the road they decide to sell it, and let's say they net $100,000. They don't have to pay taxes necessarily at that point in time. They can take the whole $100,000 and roll it back into another property, which allows them to build the wealth in that IRA faster because they're not paying out the taxes on that.
Right. And when you're talking about an $80,000 or $100,000 property, and we're talking about, hopefully a decent IRA, then you don't have to deal with unrelated business taxable income because you don't have to borrow to buy this property.
Right. And right now the lenders allow anywhere from 4 to 10 loans, and that includes your primary residence. First and second loan is counted as a loan, each one. If you're only allowed 4 to 10, you don't necessarily want to be using that loan on a property that's so small. And that's why a lot of our buyers come in with their IRA money. About 89% of our clients buy all cash, and I would say about 60 to 70% of them come from IRAs. Sometimes even husbands and wives combine their IRAs to make the purchase.
So one thing to think about related to this thing with the IRAs and to be aware is, you do have a choice or what's going on here, and that is that when the money comes out of an IRA, it's going to be ordinary income. It's not going to be capital gain. And so by holding it outside, if you have appreciation, you're going to get the capital gain. The only thing is that most people don't have $100,000 sitting around in a bank account, but they might have it in their IRA.
That's right. That's right. And so it's a good use because your IRA is for the future. And so you buy the real estate, and if you need to hold it 7 years instead of 5 years or 3 years, it really isn't going to matter because you're holding it for the future. I always tell people, make sure that you're investing with your retirement money, not your Las Vegas money or your food money. You want it to be something that's long-term investing money. Because if you're forced to sell in real estate, you may lose money. But if you're never forced to sell, you won't lose money.
Okay. So I heard you just took a group of people to Birmingham? Or?
I did, yeah. So we just had a bus tour. We do bus tours about twice a year in our different marketplaces, and so we were showing people around Birmingham. The downtown area of Birmingham, they've invested $1 billion in redevelopment, and so that means jobs.
Okay.
And we wanted to show people that Birmingham is actually a very metropolitan area. When people think of Alabama, they think backwoods, and I don't want to go there. Do people even live there? But when you get into Birmingham and you see the population and the hustle bustle of it, you really get a different feeling. And so we wanted to get people there. We showed them Birmingham. We showed them some houses, and it was a great opportunity for them to see the team that we have on the ground and to see the product.
I see. Okay. So do people need to go out there in order to make an investment?
That's a great question. And a lot of people will ask me, do I have to go to Birmingham to buy a house? No. First of all, you don't. If you're working with somebody like us, you don't have to. Now, if you're going to pick it out on your own on the internet, 100% get out there and look at it. But our processes are set up for the busy professionals that are looking to invest their money in an investment, not own a house. Okay, so this isn't a home you're moving into, this is an investment. We buy a property, we have it inspected by a certified property inspector, we do the repairs, and we have it inspected again. So our buyers have got 2 different inspectors that write up reports that we share with our buyers, plus hundreds of pictures that they can see. And every house we buy first in our inventory. So if it doesn't sell, I own it. And guess what? I'm picky on what I own. So that's a piece right there. Also, if they're getting a loan, it gets appraised. So the appraisal will tell them what the value is of the property. You know, so I just don't think that people necessarily have to go. Now, some people might want, in addition to our inspections, their own inspections. That's completely fine. When they buy a property, I encourage them to do their own due diligence. And that might be sending a friend over to look at it, or maybe hiring a property inspector of their own.
Mm-hmm.
Yep.
But again, you've got the team on the ground.
We do.
One thing, folks, so when you own a property with your IRA, personally, and having gone through an experience with a client related to this, I would say it should be almost mandatory that you use a property manager.
Yes.
It's just the prohibited transaction rules are very sensitive, so that if in some way cash from the property touches your hand, you're in trouble. You can have the whole thing blow up, and suddenly you've got taxable income as a deemed distribution of your IRA account. We have other programs related to this, so you can check that out. But anyway,
you know, Michael, on that point, it's so important when you're using IRA money to have somebody else manage it. But even if you're not using IRA money, because of all the regulations of equal housing out there, we highly recommend people use property managers. I just heard a story of a lady who turned down a prospect who was in a wheelchair, and she got sued for discrimination.
Uh-oh.
And the reason is, what she said is, the wheelchair will mark up the hallway.
Uh-oh.
And she didn't know that that was an issue to say that. And so, you know, there's so many rules and regulations. You need to work with professionals in this. Don't think that you can do it yourself, because in that, you're going to be stepping over the dollars to save a penny.
Uh-huh.
Yeah.
Yeah. So, good advice. Get a good property manager involved. And also, frankly, folks, you know, life's too short for us to be cleaning toilets or whatever. And also, I mean, we're talking about, in this case, properties that are remotely located.
Right.
So even when you have your property locally, though, it's worth thinking about having a property manager. Like you said, you've got these legal requirements that you need to deal with, and it can help you as far as relationships with your people who are leasing the property and so forth, that it's taken care of in a professional way. And again, you're not standing by the phone at midnight waiting for that telephone call to have to call the plumber.
Exactly.
So why don't you tell us a little bit, what about property taxes? I mean, here in California, we've got Proposition 13. They don't have that in other parts of the country, but what are property taxes like out in these areas for a $100,000 house or an $80,000 house?
Okay, so each county in the Atlanta market is going to have a different property tax. The same thing for each county in Birmingham. They're going to have different property taxes. But typically on a $100,000 house, you're going to be paying about $900 to $1,300 in taxes for the year. So, you know, maybe $100 a month. So it's not exorbitant. It's not outrageous. It's not Texas.
Okay.
Anyone who's invested in Texas knows that it's 3% for property taxes in Texas. And so that's one of the reasons we chose these markets over Texas, is because the property taxes are cheaper. The other thing is the property insurance is cheaper.
Yeah, that was another thing I was going to ask about.
So the property insurance on these homes typically runs about $1,200 a year, so it's not unreasonable. Now, they have had some claims in the past couple of years because of roof, hail damage, and so they are inspecting them to make sure that they're in good order, and we make sure when we sell them that they're in good order so that they don't have any issues getting the insurance on it. But again, $1,200 a year certainly outweighs what it is in Texas. And the reason I bring that up is because a lot of people go to Texas for cash flow. But the last couple of years have been hard. And in Texas, they've had so many natural disasters. The same house we had insured for $2,000, now the insurance policy is $3,600 this year. So it went up significantly.
Yeah. Well, if you think about it, it seems like the world is going to Texas, you know. Yes. It's been an extremely popular marketplace. There's a reason for it. I mean, you know, properties have been pretty reasonable out there. There are some desirable things about Texas.
No income tax.
Yeah, I like that part. So anyway, so we do have some advantages in Texas, But on the other hand, maybe looking at places that aren't as heavily picked over
Yes.
gives you a chance to get a little better deal as far as a property, getting a better price and so forth.
That's right. That's right.
And I don't know, what's your experience like with people that are renting houses? Are they just the same as people every place else, or anyway?
You're always going to have your different types of tenants. You're going to have the tenants.
Little local color.
You're going to have the tenants that pay on time every month, and they're going to stay there for 3 years. And you're going to have the tenants that you think are going to be the ones that are going to pay on month and stay there for 3 years. And after the first month of paying their rent, they don't. And you think, okay, what was the difference? And there really is no difference. But when we do our tenant screening, we're very rigorous. We check to see that they have 3 months of the net. Their net income is 3 months times the rent, not their gross. And a lot of people will use gross. Well, you know what? If
you don't get gross.
They don't get gross. So if they have alimony being taken out or high taxes being taken out, that's going to affect what they can afford to pay. So we look at that. We look at if they've had any foreclosures or evictions in the last 5 years. We don't rent to them. If it was any time after that, we ask for double deposit. And we do call references. Another thing that's a good indicator as to the stability of the tenant is how long have they been at their last job. We like to see 2 years at the last job, and if there's anything less, we'll ask for double deposit.
Okay. And again, for you people who are adventurous and decide that you want to manage your properties yourself, you just got some good advice on screening tenants. Okay, what are the neighborhoods like?
These neighborhoods are blue-collar, white-collar neighborhoods. So you're going to have teachers, bus drivers, sometimes janitors, those type of people. In these neighborhoods, you're going to drive through, and it's going to feel like a normal, safe neighborhood. You're not going to be afraid to go in there at nighttime and make a purchase or knock on the door. This is very different than buying the bulk REOs, which we talked about many years ago. So these are very safe neighborhoods. It's where your starter buyer is going to be buying homes. And we very specifically pick those areas because the whole idea is you're buying it as an investor now. You're going to rent it out 3 to 5 years, and then you want to sell it to a homeowner. You want to sell it to somebody who gets all emotional about owning a house and will pay top dollar to get it so that you get your money out of it.
Maybe the person who's even living in it.
It might even be that person, correct.
So has there been some international interest in investing in these properties?
The international interest almost matches the hedge fund interest right now. We have investors from Australia, from Israel, from France, from Japan, from China, all coming into these marketplaces. They see the stability and the value of investing in the U.S. real estate market. I think I might have mentioned it before, we're buying below the cost to rebuild. So all statistics revert back to the mean. So we at least have to come back up to how much it costs to build a house. And right now that's between $75 and $125 in these marketplaces. And we're buying and selling properties between $30 and $60 a square foot. So significant discounts. And so these foreign markets are coming in, they're hedging with the dollar, buying something that's real, that can't just disappear or vaporize, and something that is in demand because we haven't built for 6 years. But people still have babies, they're still getting married, they're graduating college, getting jobs, and wanting to buy homes. And then just recently, the feds have changed the requirements. If you have a foreclosure or a short sale, now you can get a loan after a year. So now we have even more buyer demand coming in. So the demand is going to also push the pricing up. And they see that.
Great. Okay. We have about 3 minutes left. Well, maybe you can just, share some wisdom about this whole process and so forth.
Well, one of the things that people are seeing is that we have seen some recovery in many of the markets, especially here in the Bay Area.
Yes.
And a lot of times they'll ask me about Atlanta, well, is it too late to get in? No. I look at a couple things. One is what is the cost to build? That's one factor that we can look at. We're under the cost to build. But two, what is the affordability? How many people can afford to own a home? And we are it's called high affordability right now. And lenders are starting to loosen up their requirements, and so that means that prices are going to continue to go up. So no, it's not too late to get in. It's not too late to get in the Bay Area. It's not too late to get into many of these markets. But you have to look at the numbers. You have to be wise about it. Don't just go, oh, well, Lori said it's not too late to go in. I'm going to go to Cleveland, Ohio. I don't know Cleveland, Ohio, but I can tell you Atlanta, Birmingham, you know, the Bay Area, and some of the other markets, it's not too late to get in. It's a good time to invest. And historically, I don't have all the numbers memorized, but real estate has gone up faster than the rate of inflation. For example, in 1960, the average median income was $5,600, and to buy a house, it was $15,000. So it was about 3 times, the house is about 3 times the income. Mm-hmm. Now, to buy a house, it's 4 times the income. So housing goes up faster than our income. So if you can get into the market when it's on sale, which is right now, it makes sense. Because in 10 years from now, it will have gone up more than your income will.
Right. And there are areas, I mean, there is varying recovery that's happening. So,
absolutely.
So, and some of it depends on your tolerance for that, though. You know, can you sweat it out, if you will? But when you have a situation like you're talking about here, that you can get a good cash flow
yes.
for while you're sitting through the process, because you may not be able to get that. Like if you go into Modesto, you know, you may not be able to get that kind of a cash flow from the property where you can in Birmingham. Then, you know, why not go to a place where, you know, it's going to pay you back? I mean, you can recoup your investment in 5 years,
yes.
and then anything that you make from when you sell the property is gravy, you know. So.
Well, you know, and one of the things that I learned, and I think a lot of people would agree with, is you will never lose at real estate if you're not forced to sell. Mm-hmm. And we can say, okay, well, what was the price 30 years ago? A lot less than it is now, right?
Yeah.
What's the price going to be 30 years from now? A lot more than it is now. So the question is, how do you put yourself in a position where you're not forced to sell because of divorce, because of bankruptcy, because of interest rates, mortgages, loss of job, those kind of things.
Okay, Lori, thank you.
Thank you.
Thanks for joining me. Folks, we're all out of time. We'll see you next time on Financial Insider Weekly.